Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. We begin this hour with stocks falling after Nvidia delivered a disappointing fourth quarter revenue forecast. Cameron Dawson of NewEdge Wealth looking ahead to 2025, saying tech earnings estimates are too high. Bloomberg Intelligence shows consensus forecast for tech going from plus 14 this year to plus 27 next year, even with Nvidia going from 140 this year to 50 next year. We don't see the everything else in tech able to deliver that kind of growth. Cameron joins us now for more. Cameron, good morning.
Good morning.
Is the bar too high for 25?
I think the bar is too high for that re-acceleration in tech because we don't get it from the other big tech weights. You don't get an acceleration from Apple. You don't necessarily get a big one from Microsoft. You get a deceleration from Nvidia. So it means that the market is pricing and effectively the everything else in tech truly re-accelerating. We're not quite sure if you can get that. So if you look at the 272 numbers for 2025 earnings, you look at tech, you also have to look at healthcare, which is the other area where there's a big acceleration that's priced in. It's set to go from 3% to 20% next year. But remember, expectations were for 20% this year, and all we got was 3%.
Let's stay on tech. AI, Nvidia, doing really well this year. The rest of the semi space, not so good. How do you explain the difference between the two?
It truly is AI and everything else. If you look at the equal weight semiconductor index, it's actually down 3% this year, which tells you that there is still a malaise in the old industrial, auto, China, old manufacturing part of semiconductors. That does reflect this weak manufacturing environment where we've been in, where we've had this historically long stretch of a PMI sub 50. So the question is, we do think that PMIs will start to recover only because of better sentiment. We saw that post the election in 2016. Does that translate to better manufacturing activity on a global basis? Or do you get this offset from tariffs where you still see this malaise take hold and it truly stays this world where you only have AI demand and everything else is weak?
So basically, what you're talking about is the AI side of the story that's really powered this market. A lot of people have come on the show and said they agree with you that probably expectations are too high for AI to keep leading, but that just gives everything else a chance to catch up. Those semis are going to actually have their turnaround day. You hear those types of words from the likes of Micron and Intel. Why do you think that's not the case, that the rest of the market will just play catch up, even as AI maybe doesn't grow quite as much as some people hope?
Hope does spring eternal. And we do know that if you look at these very cyclical semiconductor industries, we know that it's the most cyclical industry in the world, that you have been in this weaker environment for a couple of years. So the bar is lower for a recovery, but the big question still comes back to tariffs. Will you see companies still want to invest in big manufacturing plants that would support the demand for these semiconductors if there's a question mark about where the tariffs will come from, where should they be? And so that's that offsetting factor. Yes, the demand has been weak, but does it remain weak because of tariff uncertainty?
So everyone who's come on the show since the election has basically said, are you bullish on the U.S. or are you really bullish on the U.S.? And then I saw your outlook for this upcoming year. And basically, you're casting a whole bunch of cold water on this. And you're basically saying that it's going to be choppy. Stop being so exciting. Either you get chop that could create some drawdowns, or you get a bubble, which will end badly. Why aren't you more excited?
Well, look, we're excited. We're still bullish on the U.S. and we're still fully invested. The point is, though, is that if you think about 6,400, 6,700, all of that glosses over the path you take to get there. And the path is going to be really important. We think it's going to be different than 23 and 24. 23 and 24 was broadly up and to the right. But what we see is that because you're going in with high valuations, high sentiment, high positioning, as well as stretched expectations for earnings growth, you have this big high bar to jump over, which just suggests to get used to more volatility. So what we're talking to clients about is to say that if that volatility comes, what will you do with it? The classic Walter Deemer line of, when it comes time to buy, you won't want to. So we're trying to get our minds in process of accepting this volatility, wanting to step into it versus running away from it. But certainly we think it's that wide choppy range, not necessarily low vol up and to the right.
Is it choppy because of underlying economics or because of policy?
Probably policy. And policy, of course, could drive and influence the underlying economics. We think that big sweeping tariff policy is certainly a dampener of growth. It raises the question around at supply chain disruptions, which could be inflationary. But those policy wildcards of do we get tax reform, tax cuts or not? Do we get higher tariffs? All of these things are potential sources of volatility. And because you're trading at such high valuations today, there's not a lot of wiggle room to absorb that higher uncertainty.
So tariffs for you definitely are a tail risk. A lot of individuals have come on and said that. But a tax cut and a big tax plan, that would be a boost. How do you think about the sequencing of all this?
Yeah, well, that's the thing that we think it could be inverse from the 2016 sequencing, where we got tax cuts first and then we got tariffs, and that's one of the reasons for the weaker market that we had in 2018. This time around, tariffs could happen first, and we still have a big question mark as to whether or not you even get that corporate tax cut, simply because you are negotiating $4.7 trillion of existing taxes with a very slim majority in the House. A big question mark if you can get us down to 18% on the corporate tax rate, given everything else you're negotiating.
Let's finish on Bitcoin. Just took out 98K, all-time high, multiple choice. A risk asset on steroids, an important diversifier for portfolios, or a proxy to play some huge momentum societal shift over the next few years. Which one is it?
D, A, and B. Meaning that we think it is definitely a liquidity proxy. This is a proxy for how much liquidity is sloshing around in the market. We certainly have seen that play out in other cycles, that when the Fed is removing liquidity, Bitcoin is typically done poorly. This is a world that, given the Fed is cutting rates with financial conditions so easy, that is supportive of this kind of asset. We think it is also a psychological commodity that captures fears about dollar debasement, the fact that you have high fiscal spending, the fact that you're talking about even more monetary spend or stimulus, which just supports this notion that there are people who are afraid of dollar debasement, and thus this is their way of being able to get access to that risk.
So Lisa would like to know some form of inverse correlation between the performance of a 20-year auction and Bitcoin. Is that right?
All I can say is a psychological commodity. Tulips were a psychological commodity. You could say pretty much anything. Or
you're going to get so much love mail this morning.
I'm not just saying that crypto is tulips, but I will just say that a crypto platform founder of Tron, Justin Sun, bought a banana that was duct taped to a wall for $6 million yesterday. I
saw that headline.
So I'm just looking at this and I'm like, is that psychological kind of commodity, sort of to ease your fears?
I think that is the bubble scenario into 25, is that we get a spark of speculative fervor. And that is the scenario where you could see runaway markets because people start YOLOing on bananas taped to walls. And that could be something that would make its way into broader equity markets, where you see valuations push up into even more rarefied air.
You don't sound like a crypto purist at all. I remember these conversations years ago when we were trading down near 10K. Same conversations, and here we are up by 100.
Totally. I think that anyone who's been bearish on crypto has been humbled massively. And there's a lot of questions around exactly the idea of blockchain and how it could be used in supply chains and across a whole host of different asset classes. So there is a lot of value here.
That's a good cleanup effort, that one right there. Bitcoin right now, 98K, all-time highs, up this morning by around about 4%. Cameron, thank you.
Thank you.
Good to see you. Thank you. Cameron Dawson of NewEdge Wealth. The former Google CEO, Eric Schmidt, joined us on his latest book, Genesis, Artificial Intelligence, Hope, and the Human Spirit. Eric joins us now for more. Eric, welcome to the program, sir. I want to pick up on that one word, hope, and ask you how much hope I should have that this goes right. And start with this quote from Foreign Affairs magazine. It reads as follows. In cases where some humans might face off militarily or diplomatically against the highly AI-enabled state or against AI itself, humans could struggle to survive, much less compete. Such an intermediate order could witness an internal implosion of societies and an uncontrollable explosion of external conflicts. So you've got to calm me down, Eric. Should I have hope that this plays out well?
Well, let's start with a hope that, by the way, your show is incredible. Previous guests talked about 2% productivity. Imagine that productivity goes to 5% a year because of this technology. So there's every reason to think that there's enormous land, businesses, inventions, science, health, and so forth that get invented. But the same is also true for the invention of conflict and war. And if you think about it, it makes absolutely no sense to put somebody in a fighter jet up in the air and have them be shot at by another missile. Makes much more sense for that fighter pilot to be sitting on the ground and having a swarm of the equivalent of those jets, let's just call them powerful robots, powerful drones, that act in synchrony to achieve the objective of this attacker or to defend yourself. And the future of war is autonomous and networked and AI-driven.
This is something that a lot of people have focused on, in particular, how the U.S. is going to evolve in this manner, as well as how China is going to evolve in this manner, how they're going to use some of the space satellites to help coordinate that effort. Eric, do you feel like right now one superpower is winning versus the other? What is the best way to gain preeminence in a military AI sphere?
Well, when Dr. Kissinger and I went on his last trip to China, I was convinced from that meeting that China was 2 to 2.5 years behind us, but I am now wrong. It turns out that in the last couple of weeks, China has brought out software models, what are called large language models, that are rivals of the best American ones, which I never thought would be possible. One is called Quinn, another one's called Hongyang, and it looks like they've caught up, or they're very close behind. And it looks like China has decided that it's another part of its industrial policy, along with its focus on cellular, dominating the battery industry, dominating the car industry, et cetera. So they're willing to spend the money. What's interesting is that it does frame the narrative of China versus the U.S. as the defining narrative. And one of the more interesting questions, which we discuss at some length in the book, is what happens to deterrence and what happens to all the other 195 countries that are not China and not the U.S. These questions are really important because the power of this technology upends society in so many ways, economically, the way we govern, the way we reach, language, and so forth and so on.
So there are a lot of questions within this, and this could be a half-an-hour discussion. But one of them is who should be financing and who should be leading the national efforts to gain preeminence in this sphere. And you have to wonder, you talk about China as a state-organized, state-funded type of effort that is coordinated in that manner. How should it be directed in a place that does consider itself capitalist, like the United States?
Well, the Chinese model is what is called civil-military fusion, where they subsidize their biggest companies. No one in America, not even in the companies, thinks that the largest American companies need to be subsidized. But let me make an argument that if general intelligence, that is human intelligence, is to be invented, it should be invented in the United States and under control of Americans and the American government. And I don't mean managed, but I mean under the legal control of our country and our citizens and our democracy. And getting there first is a big deal. A number of us have talked for some time that there should be an AI for America initiative where the government works closely with the private companies and figures out a way to make sure that we are ahead of time. In truth, however, the financial industry that you all invented, for which we are incredibly grateful, has been incredibly generous in terms of the ability to fundraise the billions of dollars that are required. And I should state, by the way, that you guys have done such a good job in raising money, and we've done such a good job in actually getting the computer scientists around the world and the data and so forth and so on. What we now need is energy. We are prolific consumers of energy, and we're going to run out. One estimate is that the U.S. will run out of all sources of energy by 2028 at our current growth rate.
There's another topic you discuss in this book, which is AI to check AI. How can that work?
If you think about it, one of the things that happens is in AI systems is you have compositional generations. What happens is you take one piece and another piece and you interlink them, and they've never been linked together before. And it looks like when you combine those two, you get emergent properties. Right? So that's in and of itself interesting. So the question is, what is the limit of that? How far can that system go up? I think it will get there. And I think that it's probable that we can build systems that are, the technical term is super intelligent, where you have a single system that is at the 90th percentile of physics, math, chemistry, and arts and so forth. No human can do that. It looks like these systems will be not only available in the next 5 years, because we already have examples of passing these tests already, but also that they'll be broadly available for all of society. that has huge implications. We've never had an experiment where each and every one of us has a polymath, the Einstein-type scientist at our beck and call. And furthermore, that scientist, whatever you want to call him or her or it, is capable of writing code, doing agents, and making things happen.
How do you think the United States competes with China when we have an incoming administration that wants to put up tariff walls, and even this administration who's been putting export controls on some of our high-tech semiconductors?
I am not in favor of broad tariffs. I never have been. I'm the son of an economist and a grandson of an economist. And tariffs are essentially taxes. What I am in favor of is restrictions or limitations for strategic reasons. It's really important that we win in this race against China. And so the things that the Trump administration and Biden administration to limit, for example, hardware access were really smart. And I know because I was part of a commission that recommended it way back when. And it, in fact, was adopted. Great job. So the question here is, ignoring the tariff question, which I just don't like, and I think is just another tax, how do you control and limit what China does, and how do you amplify what America does? And you sit there and you go, well, you're doing pretty well, right? Everybody's making a lot of money. There's all this growth. NVIDIA's doing well. All the tech companies are doing well. But let me explain what happens. You have a slope that's like this, and it keeps going up and up and up with humans. At some point, the industry believes that there will be AI scientists, that is non-human scientists, and he or she who gets there first gets a slope like this, and all of a sudden, boom, right? We're really, really growing fast. These network effect businesses are what we do in our competitive environment against each other under U.S. regulation. I want that to be true globally for the U.S.
Eric, I can tell you we're all in favour of having you back soon to continue the conversation. Congratulations on the new book, sir. We appreciate your time. The former Google CEO, Eric Schmidt. Begin this hour with Trump's Treasury pick still very much up in the air. Following meetings with Apollo's Mark Rowan and former Fed Governor Kevin Warsh, investors still waiting for President-elect Donald Trump to make a final decision on the individual who will go into 2025 facing down a huge to-do list. Joining us around the table, the IBM Vice Chair, the former National Economic Council Director, Gary Cohn. Gary, good morning.
Good morning. Thanks for having me.
Good to see you. Thanks for being here. I think we need to take a big step back, in fact, go several years back to 2016, 2017. Just frame for us what you had to face down in 16 going into 17 and how long the to-do list was back then.
So I think we should take even a bigger step back and remember what the environment was. If you go back to the economic environment as we were going through this exact period, we had a environment where we had just barely started to come out of the Fed's zero interest rate policy, quantitative easing, and a decade of Fed articles, will there ever be inflation again? We were just starting to turn that corner. We had come through an Obama 4 years or 8 years of basically saying, there's been a very tough business environment, highly regulated. How do we get business re-engaged? And Trump won this victory. It looks very similar to where we are today, except, Fed funds were 76 basis points back then. They're 4.5% today. National debt was about 20 trillion. We're at $35 trillion right now. So we're in a pretty fundamentally different place. And then as you look where we are today, not only have we a pretty decisively different position in rates and debt, I think the president-elect is walking into an environment with that high interest rate environment where housing prices have gotten really out of touch for most Americans. And there's a real push to try and make housing more affordable. You look at the way Treasury has decided to fund that additional debt. They've been very short-dated on the curve, which I think provides an enormous amount of risk in refunding. And we all worry about refunding of Treasury. So I think we've got to have a real refunding situation where we roll out maturities. I remember talking to the president like 8 years ago about doing a 50-year and a 100-year. I still think we should have done a 50-year and a 100-year when rates were low. And then you think about the situation with state and local governments. State and local governments were not in great position 8 years ago. Now think of what's going on with the migrant population, how much money some of these cities and states have spent on immigrants. Now, they didn't say anything prior to the election. But I will be shocked if there's not a huge outcry from some of the major cities in this country about the amount of money they've spent and how much help they're going to need from Washington to make their budgets come together. So that's where you start. That's literally day one. That's January 20th, 12 noon. You walk into that.
Yep.
So there's a fundamental difference from where we are. But there's a similarity to coming off of the Obama administration versus the Biden administration, the excitement of business, the opportunity going forward. Those are the excitements. Then you go back eight years ago and say, okay, what did we walk into as well? Well, look, the number one policy that we really wanted to get done initially was tax reform. Tax reform was our number one objective. Unfortunately, the House had sort of gotten ahead of the White House. During the last few weeks of the prior administration, the House had gone ahead with repeal of Obamacare. So we walked into repeal and replace without really a replace.
Which I have to admit, I totally forgot about. I totally forgot about the McCain vote.
Yeah.
I'd totally forgotten that you'd walked into that back in 2017. How did that complicate things to get taxes done?
Well, it highly complicated things. We all thought on the economic team that we were walking in, we were going to, January 20th, we were going to start on tax policy. I think all of us got thrown into healthcare, trying to figure out healthcare. None of us were really healthcare experts. None of us had been doing work on healthcare for the prior 3 months trying to get ready to walk in. We'd all been working on tax policy and trying to figure that out. So everyone got derailed for the better part of, I would say, 2 months or 3 months, knowing that we wanted to go through taxes in year one because we wanted to use that budget that existed, and we wanted to use budget reconciliation to get taxes done that year. So every day we were spending on healthcare, we were losing a day of tax policy, which was, it was anxiety creating, let's put it that way. So we were trying to get rid of the healthcare issue as quickly as we could.
What's going to be the priority when they walk in January this time around? Is it going to be tariffs, or is it going to be cutting taxes?
So I think there's two priorities day one. On the economic side, and you'll argue there's both economic. I think it's going to be taxes because, again, you've got a deadline. Remember, the personal side of the tax policy ends at 12 midnight, December 31st, 2025. So there is a forcing function. And Washington operates really well with a forcing function.
They need deadlines.
They're
like journalists.
Well, I don't know about journalists, but I know about Washington. They need a deadline. There is a hard and fast deadline. Now, look, they could extend it, but that would be another act of Congress to extend it. So they have a firm deadline in place. So number one thing on the economic policy front is they're going to deal with taxes. Number two is, I think, simultaneously, we could argue this is economic as well. They need to deal with the immigration policy. I think we will see Trump come back to many of the executive orders and many of the policies that he had going out on January 20th. He will reinstate all of those policies to shut the border and at least stop the flow of illegal immigrants into the United States. So I think they will work on both of those simultaneously. I do think there will be some tariff policy going in there as well. And I think the tariff policy that will be relatively easy for them to go on is to tariff things that we are currently manufacturing in the United States, where you would put tariffs in place to protect jobs and protect the products that we are currently making in the United States.
Okay, so personnel policy, we have 2 out of the 3. We have a border czar, he's announced, and we also have Howard Lutnick going over to commerce. What is going on with the Treasury pick? We have 3 men who I've been told the president thinks are of high caliber: Scott Bessent, Mark Rowan, Kevin Warsh, in Palm Beach yesterday, having these conversations with the president. You know how he operates. Why is this pick taking so long if he ran an economic agenda campaign?
So I think you just answered a little bit. He ran an economic agenda campaign. This is in his opinion, this is one of the most important, if not the most important pick he is going to make. So getting it right is important. I'll also remind you something. We'll go back to 8 years ago. The economic picks were made the week after Thanksgiving. I was hired the week after Thanksgiving. Mnuchin was put into his job the week after Thanksgiving. So the transition team is a couple weeks and probably a month ahead on most of the picks. So, we've all got this anxiety because, look, this is a second-term president, so he knows how to get stuff done quickly. But if you think of what happened 8 years ago, those picks were made in the last week of November, first week of December, and we were all ready to go in our chairs in place by 12 noon, January 20th. So there's plenty of time to get it right. And I think the president-elect knows, getting the right person is more important right now than getting the pick done today or tomorrow.
Do you think it's a name that I have not reported on?
Look, I'm not involved in the process. I think the president will put any and every name that he thinks can do the job well on the list, and he will choose what he thinks is the best person to do the job.
Do you think it's feasible for President-elect Donald Trump to achieve his goals of the tariffs that he's put out there while acquiescing or creating some calm in the bond market?
Look, we will see what actually happens in policy. You know, as I always remind people, what you say to get elected and what you do in actual policy are two different things. You know, Americans like to hear what your ultimate idea is to get done, but we've got a very rigorous policy process in the United States. We've got a House, we've got a Senate, we've got lots of constituencies, and when it comes down to actually executing and implementing policy, it is not exactly what the president wants. In fact, every piece of legislation is a compromise. There's no perfect piece of legislation in America because at some point people have to compromise. So we'll see what the president can get done. I mean, I think we're all confident there'll be something on taxes. We're 100% confident there'll be something on immigration, and there'll be something on tariffs. But again, each of these will be a compromise. No one is going to get 100% of what they want.
I guess the reason why people are so interested in the Treasury pick is because people want to understand what that compromise might look like, and the individual might give some insight into that. Do we have a sense, and will this sort of be the ultimate test for you, how much Congress pushes back on some of the picks that have already been announced that are controversial even among Republicans? Will that be sort of a test of just whether the checks and balances will work at the same time when a lot of people are saying this time is different and that this president-elect actually has something of a mandate that is very different than in 2016?
I think every Congress and every president, when they come in, and they put their nominations through and they go through the consent process, it's different every 4 years. Every president goes through a different process. You have a different makeup of a Senate. You have a different sort of body. And by the way, the body will be different at the end of this year, and then it will transition. I think it's January 3rd is the swearing of the new Senate. It will change January 3rd in the middle of the process.
Right.
So some of these nominees could actually go through an approval process with this current sitting Senate. Some may go through with a new Senate. Probably the vast majority will go through with the new Senate because it takes time to get the paperwork through. It takes time to get the vetting through. But every one of these events is unique, and it's uniquely different because there are different personalities involved. There's different people went through different elections.
Yeah.
Certain states changed. They became redder. So the senator may or may not be more comfortable taking a certain point of view. So you literally have to watch each of these as an individual, unique event.
So you did mention the financing of the deficit, and that's very interesting to me, especially at a time where you talked about the short-term nature of a lot of the financing. Do you expect that to change, for there to be a lot more longer-dated issuance regardless of where yields are at with the next Treasury Secretary, whoever that may be?
Look, I think it's really prudent risk management to start elongating the debt of the United States and not have to live off very large short-term auctions and not have to live off a short-term demand for treasuries. Like, we're always worried about financing the deficit and what could happen. Like, as a person that grew up as a risk manager running a large balance sheet for a large percentage of my life, you would want to de-risk that. How do you de-risk that from a treasury standpoint? You roll out maturities as long as you can, so you cut down the amount that you have to fund at each of these auctions. So I would think that this administration would want to get that done and roll out maturities.
Gary, I want to pick up on a conversation we were having earlier. The race to be the next Treasury Secretary. You've been in the room with President-elect Donald Trump many a time, including to interview. What's it like to interview with Donald Trump?
Well, look, it's always a stressful experience. You know, you're sitting there with the president-elect and a large amount of his team. Like, usually when you're in the room with the president-elect going these interviews, there's multiple other people in the room. You know, I always reminded myself, I'm speaking to the president-elect, I'm not speaking to the other people in the room. So you've got to sort of block out the other people in the room. But he's rigorous in his questions, and he tends to go multiple different directions. So, he'll go from topic A to topic B to topic C, back to topic A. It's interesting. You've got to be on your game. When you're in there, you've got to be on your game, and he's thinking, in multiple directions. And it's very interesting. And he's always got an interesting spin on things. I think the President-elect Trump is one of the best marketers and branders I've ever seen. So when I'm always talking about an answer and how I would think of something from a policy standpoint, he's talking about it. How is he going to sell this to America, and how is it going to affect people, and how is it good for the country? And he's thinking in that term. So we're always having an interesting conversation where I'm thinking about it from an economic policy, markets policy standpoint, and he's thinking about it from how do I sell this and how do I get momentum for this?
Some space in the media are describing this process as looking for a yes man, someone who will just say yes to some of his policy proposals, including trade. You had disagreements with him on trade. You were very open about that. We were all aware of it at the time in the first term. How open is he to those disagreements?
Look, I believe it's the job of an advisor in the White House to tell the president the truth and tell him things that he doesn't want to hear. Now, you get to tell him plenty of things he does want to hear. It was always fun to go in there with the economic data. You get the economic data the night before it's released. And there were many nights where I got to go in there and talk to him about the economic data, what it was, how good it was, how the markets were going to react. Those are great conversations. But along with those great conversations, you get to go in there and have conversations that say, hey, look, if we do X, I think the reaction is going to be this. Are we prepared for this intended or unintended consequence? And I think those are the jobs of the people that sit in the White House as advisors, to make sure when the president does something, they understand the intended and unintended consequences. A president should never be blindsided by a decision.
When it comes to the check and the pushback on Trump 2.0, John talked about this his first 4 years all the time, the Trump put. It was a stock market that he cared about. He would reverse course on potentially something he wanted to do, an executive order, just because he saw the fallout in the financial markets. What's going to be that check this time?
I think Trump is going to care as much about the stock market these next 4 years as he did the first 4 years. That is a benchmark that he will measure himself. It's a very public benchmark. It's one that he uses. He talks about it in every speech. He's already started talking about it in the transition, how well the market's done since election night. I don't think that will change over the next 4 years.
Do you think the bond market takes on additional importance? We started this whole conversation about the difference between now versus, say, 2016-17. Certainly in fixed income, in a very different position.
Look, I think the bond market deserves a long discussion here. I think there's a lot going on. When I talked a little bit ago, where Fed funds were at 76 basis points, where they're 4.5% now, that's only half the story. We had a flat yield curve, and then we've gone through an inverted yield curve over the last 4 years because everyone was worried about a recession. And now we're going back to something that we forgot what it is, called a normal yield curve.
How steep is a normal yield curve?
Yeah, like at least you've been around long enough to ask a question, how steep is a normal yield curve? Because a lot of people don't even remember a normal yield curve is steep. We've seen since the Fed started cutting interest rates, 10 years have gone up 60 to 70 basis points. I'm not surprised by that. I think we're renormalizing a yield curve. If we've taken recession fears off the table and the 10 year is going to go to a normalized rate of, let's call it 3.5%, there has to be at least 100 to 125 basis points of steepness in Fed funds 10 years. I think it's at least 125. If we're going to 3, that's at least 4.25. If we're going to 3.5, we're talking 4.75, and we're going to continue steepness out the curve. And that's before we get to what I consider a pretty large refinancing wall coming up in 25 and beyond. I think many people forgot that, 2020, the COVID year, we did a lot of refinancing in the market, but most of them were 5-year refinancing. So a lot of that COVID paper that was done at pretty favorable rates, because the Fed, again, went into very accommodative policy. Yep. A lot of that COVID paper comes due next year. So we've got a lot of refinancing coming due in 2025. So I think the yield curve smartly and normally starting to re-anticipate what's going to happen in the bond market.
We could talk all morning. Let's do it for now next time. It's good to see you, sir.
Great seeing you.
Appreciate it. Gary Cohn there, the IBM Vice Chairman and former Director of the National Economic Council under Donald Trump.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.